Most investors think wealth comes from picking the right asset, the right stock, the right crypto, the right property. But here's the uncomfortable truth. Most investors will never be wealthy, even if they pick good assets, because wealth isn't created by assets. It's created by control, structure, and scale. Good returns don't build wealth. You can earn 8%, 10%, or even 15% and still never shift your financial position. To move from retail thinking to institutional thinking, study businesses, not stocks. Learn deal structures. Understand who gets paid first. Think in terms of control, not ownership percentages. You don't need to do private equity yet, but you must understand how it works. To move from retail thinking to institutional thinking, study businesses, not stocks. Retail thinking asks, what's the ticker? What's the price? What's the return? Institutional thinking asks, how does this business actually make money? And how fragile is their cash flow? Here's the truth most people miss. Stocks are just receipts. Businesses are machines. Retail investors obsess over price movement. Institutions obsess over business mechanics. They study who the customers are. How recurring is the revenue? What happens if demand drops 10%? What costs are fixed versus variable? How easy is it to replace management? Whether the business can survive without the founder? Because if the business is weak, no good stock will save you. That's why institutions can buy a boring company like HVAC, logistics, healthcare services and turn it into a gold mine. They're not guessing. They're analyzing systems that produce cash. If you can't explain how a business produces predictable cash flow, you're not investing. You're speculating. Learn deal structures. This is where the real power is. Most people think money is made when you buy low and sell high. That's retail myths. Institutions know money is made when the deal is structured, not when it's exited. Deal structure decides who puts in how much money, who takes the risk, who gets paid first, who gets upside even if the deal struggles. This is why private equity firms can put in only 10 to 20% of their own money, use debt strategically, still collect management fees, still get paid even before the final exit. Retail investors make money only if their market bet is right, whether that's price going up, down, or behaving exactly as expected within a limited time window. Institutions make money while they wait. If your return depends entirely on hoping it works, you're not playing the same game. Understand who gets paid first. This changes everything. Retail investors ask, what's the return? Institutions ask, who gets paid first? Because wealth is not about how much money is made. It's about who gets paid first when things go wrong. In a typical deal, lenders get paid first. Preferred investors get paid next. Equity holders gets paid what's left. Retail investors almost always sit last. Institutions structure themselves closer to the top. As lenders, as preferred equity, with covenants and protections. That's why they survive downturns. That's why they lose less. That's why they stay in the game long enough to compound. If you don't know where you sit when things fail, you don't understand your investment. Think in terms of control, not ownership percentages. Retail investors obsess over how much do I own. Institutions obsess over who controls the decision. Because 10% ownership with control is better than 100% ownership without control. Control decides strategy. Control decides timing. Control decides exits. Private equity firms often don't own 100% of a company, but they control the board, the management decisions, the capital allocation, and exit timing. That's why they can force outcomes instead of waiting for them. Retail investors wait for the market to cooperate. Institutions engineer outcomes. Ownership without control is exposure. Control without ownership is power. Retail investors play offense only. They win if everything goes right. Institutions play defense first, structure second, upside last. That's why they survive cycles. That's why they stay rich. That's why they're always positioned for the next opportunity. Over the next decade, millions of businesses will be sold. Owners will retire. Assets will change hands. Retail investors will watch. Institutions will buy. The question is, which side will you be on? Most people invest hoping to win. The wealth is structured deals so they can't lose easily. That's the difference. Subscribe if you're done playing the retail game and ready to learn the institutional one.